Hey, welcome! If you've ever had an idea for a business or even just wondered how giant companies actually tick, you are in exactly the right place. Today, we're going to break down a topic that sounds super intimidating, but is actually the key to, well, pretty much everything in business: accounting. And don't worry, forget the complicated math. We're here to learn the language that every single business speaks.
I want you to think of a business like this balancing scale. It's simple, right? On one side, you've got everything the business owns, and on the other, you have everything it owes to other people, plus whatever the owner's own stake is. This idea, this concept of balance, it's the single most important thing we're going to cover today. It really is the secret to understanding any company's financial story. So, to understand that story, to figure out if a business is a huge success or maybe a bit of a disaster, we first have to learn its language. And that language, you guessed it, is accounting. Okay, here's the formal textbook definition, but please do not let these words trip you up. Look, all this is really saying is that accounting is the system for taking all the numbers, every single sale, every bill, every paycheck, and turning them into a clearer picture. A picture that helps owners and investors make smarter choices. That's it. It's all about turning data into actual decisions. So, what does it actually do? Well, first off, it's like a super detailed diary for every dollar that comes in and goes out. Second, it uses that diary to create report cards, we call them financial statements, that show everyone how the business is performing. Third, and this is a big one, it keeps you out of trouble with the law and the tax man. And finally, it basically gives you the roadmap you need to plan for the future. All right, let's get to the absolute heart of it. If you remember only one thing from this entire explainer, please make it this next part. We're about to pull back the curtain on the one golden rule that holds the entire world of accounting together. And here it is again, our trusty balancing scale. It perfectly shows us the golden rule, which is just a simple little equation. Assets must always equal liabilities plus owner's equity. It never, ever changes. But okay, what do those words actually mean? Let's break them down one by one. First up, we have assets. Honestly, this is the easy one. It's all the valuable stuff a business owns. We're talking cash, computers, inventory on the shelf, anything that has value and belongs to the company. Just think of it as what you own. Next, we've got liabilities. And this is basically the other side of the coin. It's everything the business owes to other people. Think bank loans, bills from your suppliers, the balance on the company credit card. If you've got to pay it back, it's a liability. Simple as that. This is what you owe. And finally, there's equity. This is the owner's slice of the pie. Here's a good way to think about it. If you sold off all your assets and used that cash to pay off all your liabilities, whatever money is left over, that's the equity. It's the owner's true stake in the whole thing. It's what's left over. So let's put it all together one more time. Assets, what you own, has to equal liabilities plus equity, what you owe plus what's left for you. See, everything you own had to come from somewhere. It was either bought with borrowed money or with the owner's own money. This isn't just some abstract theory. It's the bedrock of everything. It must always, always be in balance. You could call it the law of financial gravity. Okay, theory is great, but let's make this a little more real. How does this actually look in the wild? Let's take a super simple example, say a small coffee cart business, and figure out what its assets and liabilities might look like. So for a little coffee cart, its assets are pretty easy to picture, right? There's the cash in the till, that shiny espresso machine that costs a fortune, all the bags of coffee beans and cartons of milk, that's inventory, and maybe even the little van it uses for deliveries. All valuable things that the business owns. Now on the flip side, what might it owe? Well, it probably took out a bank loan to buy that van. It almost definitely owes its coffee bean supplier for the last big shipment. And it might have an unpaid electricity bill sitting on the counter. All of these are claims against those assets we just talked about. These are the liabilities.
So, we get it now. A business owns stuff and it owes stuff. But this brings up a really crucial question. Who is ultimately responsible for what is owed? The answer to that changes completely depending on how you set up your business, and the consequences are massive.
And you really need to get this because whether you decide to be a sole trader, that's just you flying solo, or you decide to bring on a partner, that choice fundamentally changes your relationship with the business's debts. It changes your personal risk. So let's compare them. As a sole trader, it's all you. It's simple to set up, you have total control, and you get to keep all the profits. Sounds pretty good. A partnership, on the other hand, is amazing for combining skills and money. You can do way more together than you probably could alone. Both options look pretty good on paper, right? But now,
Let's look at the downsides. Do you see that big, scary phrase on both sides? Unlimited liability? For a sole trader, that means you are personally on the hook for all the business debts. For partnership, it's actually even riskier. Not only are you on the hook, but you're also responsible for your partner's actions and their share of the debt.
Let's be absolutely crystal clear about what this means. Unlimited liability means there is no legal wall between you and your business. They are one and the same. So if the business can't pay its debts, the people it owes money to can come after your personal assets. We're talking about your car, your personal savings, even your house. Suddenly, that whole balancing act isn't just about the business anymore. It's about your entire life. So, we've seen that accounting really is the language of business, and it's all built on a simple rule of balance. But we've also seen how that simple balance connects directly to your personal risk. It's the story of what you own, what you owe, and what is truly at stake. So the final question to think about is, if you were to start something today, what story would your numbers tell?